There is a war in the Middle East. Active strikes, real casualties, oil supply at risk. The dollar is soft. Central banks, including China, have been buying gold every single month for over a year. New buyers from Chile, Guatemala, Malaysia, Indonesia. The long-term thesis for gold is intact by almost any measure you want to use. And gold just fell from $5,500 to $4,560. That's not a rounding error. That's a 17% collapse during an active shooting war, during the exact conditions that are supposed to make gold go up. So either everyone who told you gold was the ultimate safe haven was wrong, or the story is more specific than that. I think it's the second one. And once you understand why gold sold off the way it did, you'll read today's session completely differently. Because right now, at $4,560, there is a real setup forming. But it only makes sense if you understand what actually drove the price down in the first place. There's a word for it. I'll get to it in a second. The word is war-flation, and it explains almost everything that happened over the last few weeks. Here's the chain. The Iran conflict pushed oil higher, not dramatically, but enough to matter. Higher oil meant higher inflation expectations. That pushed bond yields up. The 10-year Treasury is sitting at 4.407% right now, up 7 basis points just today. And when yields rise, gold loses. Not because gold gets weaker in some abstract sense, but because the opportunity cost of holding it becomes real. You can earn 4.4% in a Treasury note. Gold pays you nothing. For big institutional money, that math changes positioning fast. But that's only half of it. The other half is even more counterintuitive. Some of the central banks that had been buying gold, the same ones in the World Gold Council data, started selling. Not because they changed their minds about gold, because they needed dollars to pay for energy imports. Oil priced in dollars got more expensive. Gold was liquid. So gold went out to cover the bill. Think about that for a second. The war that was supposed to drive gold buyers into the market was simultaneously forcing some of those buyers to become sellers. That's war-flation. It is not a speculative scenario. It is what actually happened. And this is where the gold is a safe haven story needs to be made more precise. Gold is a safe haven against monetary disorder, against debasement, against loss of confidence in the currency system, against the slow unraveling of the idea that a dollar is worth a dollar. It is not a safe haven against supply shock inflation driven by an oil war. Those are different problems. Gold solves one of them. It cannot solve both at the same time when they pull in opposite directions. That distinction matters today. It changes what you're watching and why. 3 things are pressing against gold right now. They're connected. You can't treat them as separate line items. First, the dollar. The DXY, the dollar index, is at 99.36, up a small 0.13% today. That number looks harmless, and honestly, for today's session, it is soft enough to support the rebound gold is putting in overnight. But soft is not weak. The dollar hasn't broken. It's sitting near the low end of its range, and any catalyst, a hot European inflation read, a hawkish Fed comment, a sudden geopolitical spike, could push it higher quickly. When the dollar strengthens, gold reprices in real time. Not slowly, fast. Second, real yields. Not the nominal 10-year, the inflation-adjusted number, what you see in TIPS pricing. Real yields are elevated. This is the one that large institutional desks actually trade against. Nominal yields are noisy. Real yields tell you what holding gold actually costs compared to holding a risk-free asset that pays you back with purchasing power intact. Right now, that cost is meaningful. That's a headwind that doesn't go away until the Fed actually cuts, and we're not there yet. Third, the Fed itself. They held rates at 3.5% to 3.75% at the March 18th meeting. One cut is still in the forecast for later this year, but Powell was explicit. Inflation risks are tilted higher because of energy. The phrase he used was essentially, wait and see. For gold, that translates directly. No relief on rates is coming soon. The market knows this and has priced it in. So here's a question I want you to sit with while we go through the rest of this. Of those three, the dollar, real yields, the Fed, which one do you think is the most dangerous to today's rally? Keep that in mind, because the intraday setup will make the answer pretty clear. None of that means the big picture is broken. China bought gold for the 15th consecutive month. Chile added gold for the first time in decades. Guatemala, Malaysia, Indonesia, countries that had stayed out of the gold market for years are now putting it on their books. These aren't speculative moves. Reserve managers are not traders. When a country adds gold to its reserves, that decision went through layers of institutional approval. It doesn't reverse in a week. The World Gold Council's current position is that central bank buying will resume at prior pace once the energy crunch eases. That's a conditional, and it's an important one. It means the selling we're seeing now is situational, not structural. It's energy crisis selling, not a change of conviction. De-dollarization is moving slowly, slower than the loudest voices on the internet suggest, but it is moving. The marginal shift in reserve composition, away from pure dollar exposure toward gold, toward other reserve assets, is real and it's continuing. That doesn't make gold go up next Tuesday, but it does mean the floor under the long-term price has been rising for years and is not going away. Here's the distinction that I think most retail traders miss. A 17% pullback in a structural bull market changes your entry point. It does not change your thesis. Those are completely different things. If you're long gold because you believe in the 5-year case, central bank demand, monetary fragmentation, de-dollarization, a correction to $4,560 is not a problem. It's a level. The question is whether it's a level worth trading today. And that's where the technical picture comes in. Gold cleared the daily pivot point at $4,421 in the overnight session and has held above it. That's the first meaningful structural positive on the chart today. The daily pivot matters because institutional desks use it as a reference level. It's not magic. It's just a price that a lot of risk management systems are watching simultaneously. When gold trades through it and holds, that shifts the intraday bias. Buyers who were waiting for evidence that the sellers are exhausted get it there. Volume profile shows real buying interest clustering around $4,500 to $4,520. That zone is acting as a base. VWAP, the volume-weighted average price for the session, is providing support on dips. When price keeps bouncing back above VWAP rather than sliding through it, that tells you the average buyer in this session is still profitable. They haven't started panicking. The selling is being absorbed. Options are relatively quiet today. Put/call premium ratio is sitting at 1.04, essentially neutral, slightly favoring puts, but nothing that signals a major institutional hedge or a big directional bet. That matters. When options positioning is neutral and gold is rallying, the move is being driven by spot buying, real bids in the market, not derivatives positioning. That's a cleaner signal. It's also a more fragile one, because it means there's no large institutional options position supporting the move if it turns. COMEX inventory is comfortable, roughly 32 million ounces total, about 16.5 million registered and 15.5 million eligible. No tightness, no squeeze in sight. One of the fastest ways gold can spike is a sudden tightness in deliverable supply. That's not happening right now, which removes one potential explosive catalyst from the bullish side. GDX, the gold miners ETF, is moving in line with the metal today. That matters as a confirmation. Miners typically move 1.5 to 2 times as much as gold itself on big days. When they lag, it's often a sign that the move in gold is being driven by something thin, short covering, news flow, rather than genuine conviction. Today, they're moving together. That's constructive. One more thing on the calendar. There is no major U.S. data today. No CPI, no PCE, no jobs numbers. There are European readings and an ECB speech from Lagarde, but nothing that typically shakes the U.S. tape hard. That means today's price action will be driven by order flow and news, not data surprises. In practical terms, that means the chart is more reliable than usual. Levels will be respected more cleanly without a data shock to blow through them. The tape, right now, is two-sided. Buyers are stepping in aggressively near $4,500. Sellers are capping the move somewhere above $4,600. That's not a trending day. That's a range. And range days have a specific kind of trade. The intraday bias is mildly bullish. That's a conditional statement, and the conditions matter. Price stays above the pivot at $4,421, and the dollar doesn't break higher. The setup is a tactical long on pullbacks to VWAP or to the $4,500 zone. Target is $4,600 to $4,650. Stop goes below the pivot, firm, not soft. The logic is straightforward. This is a range trade, not a breakout. You're buying support inside the range and selling into resistance. You are not chasing a breakout above $4,650, hoping gold accelerates. Not today. Not in this environment. Size small. This cannot be said strongly enough. The market is news sensitive right now in a way that makes normal intraday volatility look tame. A single headline, fresh strikes, a yield spike, a comment out of the Fed can reverse an hour of buying in 4 minutes. Position size is risk management on a day like this, not a lack of conviction. Two numbers to watch tick by tick, the DXY and the 10-year yield. If the dollar breaks above its session high, reduce exposure. If the 10-year yield spikes above 4.45%, step aside and wait for price to reprice before re-entering. These are not arbitrary levels. They're the inputs that are directly driving gold's short-term behavior today. When those inputs shift, gold shifts with them, and staying in a position because the setup looked right earlier is how traders give back gains fast. The risk to the downside? A negative Iran development, any escalation that pushes oil sharply higher and reignites inflation fear, or a hotter-than-expected European data read that strengthens the dollar. Any of those can trigger selling that overwhelms the technical setup within minutes, not hours, minutes. Drop your levels in the comments if you're watching this session live. Where are you looking to enter, and what's your stop? I'm curious whether people are anchored to the $4,500 zone or whether they're waiting for a deeper pullback toward the pivot. Let's see what the range of thinking looks like. One last thing on execution. On a day like today, the discipline that matters most is not knowing when to get in. It's knowing when you're wrong and getting out before the stop forces you to. Every experienced trader has a version of this lesson. The stop is not the exit. Recognizing that the trade has failed before the stop hits, that's the exit. In a choppy, news-driven session, the ability to read the tape and act before the level breaks is worth more than any entry signal. Gold is not complicated. It's a mirror. What it reflects is confidence in currencies, in central banks, in the idea that the monetary system is basically stable and that the promises embedded in paper assets will hold. When that confidence frays slowly, gold rises slowly. When it frays fast, gold rises fast. What makes today hard is that confidence is fraying in two directions at once. The long-term case for monetary fragmentation is intact. The short-term case for higher for longer rates is also intact. Those two things are pointing in opposite directions at the same time, and the price is the result. The trader who understands that doesn't need a prediction. They need a framework. Levels, conditions, exits. That's what today's session offers. One final thing, and I say this in the same voice I've used for everything else. This video is for educational purposes only. Nothing here is financial advice. Markets move fast, circumstances change, and the only person responsible for your decisions is you. Do your own research, manage your own risk, trade what you understand.